All righty. All righty. Hello everybody. I think we're live here. And we got Larry Moore, NGL. We were just in the studio here doing some work. We were actually recording a session that we were releasing, but we wanted to go live right now. And so it's been very interesting. If anybody's got any questions, anybody's there. We've covered a lot of topics here in the last 2 hours in our studio session that we'll be releasing along the way. Couple things, Larry, that people might have thoughts about. We covered already, but let's share with our audience here. There are people possibly out there that are getting long-term care rate increases.
Mm-hmm.
All right. Explain, and I had my own stepfather call me up.
Yeah.
Why am I getting rate increases?
Right.
A good friend of mine, they're getting rate. Why, Larry, are rate increases happening for people?
So if you go back in time, early in the industry, these are old blocks of business. Some of them are more recent, but the assumptions that carriers had access to were untested at the end of the day. When I mean assumptions, I'm talking pricing assumptions in terms of how much liability remains on the books at the end of the life of business. What are your interest rate assumptions? But more importantly, morbidity. And morbidity is a fancy word for old disability, if you want to look at people. And as a consequence, the pricing was inadequate because they didn't have the experience.
That's right.
So where we are today, we have the experience. But what you're starting to see in the form of rate increases were those old blocks of business that weren't necessarily priced appropriately. And it wasn't out of malice by the carrier. They just didn't have the experience.
Right.
More recently, we're seeing some rate increase activity come from newer blocks. But again, the question is, what were their morbidity assumptions? What were their cost assumptions at times of claim and all that? So that's what's happening.
Mm-hmm.
They're unfortunately, those consumers are at the mercy of the learning curve that our industry had to bear. And that's what's going on.
And we said earlier too, not only the morbidity factors were off, the research wasn't there for them to do it years and years and years ago, but also the low interest rates that have been along the way, and these policies that people are on are, they're guaranteeing 5%, 3%.
It's funny you bring that up because I did mention this before, but it's a true story. So in Amex Life back in 1990, there was talk that we need more than a 2% or a 3% inflation rider. We need 5%.
Right.
And I kid you not, I was in this room with our chief pricing actuary and a couple other folks. Well, what should it be? Well, the prime lending rate's about 10%. I think we're safe if we put 5 in there. I swear to God.
Yeah.
They said that feels pretty safe. At that time in history, interest rates were higher. So witness where we were for about 20 years.
Right.
1%, 2% rate of Treasury was barely 100 basis points.
Wow.
And that's why the newer blocks are being punished, because they were priced for a higher interest rate environment in many cases, and they need to make sure reserves are where they need to be.
Right.
Future claims. So.
Well, and we've been talking too. You're with NGL. Why don't you give people a little heads up who NGL is? You've been with them for a handful of years, but there's some exciting stuff over at NGL. So share with us a little bit what's going on there at NGL.
Sure. NGL is a 110-year-old mutual company, but they've been in the long-term care space for a short while, since 2016, which is actually a really good thing. We were coming out of that low interest rate environment. We priced our products. We priced for that. We priced appropriately for the risk. We underwrite appropriately for the risk. So as a result, our little mutual company is quite profitable in this space. So that's important. The other thing that's important is that this little mutual company doesn't have any legacy business that they have to worry about with what you see going on now. Now, I'm not saying there's guarantees out there that we'll never have to make a rate move. I can't say that, but our profitability picture right now takes us years down the road, which is good news. We have a product that's uniquely designed for couples.
Okay.
And our definition of a couple is very loose. It's basically two people sharing expenses under the same roof. So that's the part of the market we tend to dominate.
Got
When
it.
it comes to individual males and females, we share that with everybody else. And then, as far as that goes, we're also paired up with a really highly experienced third-party administrator who handles all the admin
Got it.
for this. So when NGL came into this, as was my concern, do they know what the heck they're doing? And I realized they smartly recognized that, we're not going to be experts at administering this stuff. Let's find somebody that is. So that's kind of our story, A-rated company out of Minnesota, Wisconsin, Madison, Wisconsin.
You've been there a few times, haven't you?
I've been there a couple times. Great town, too. But, that's our story.
That's great. That's great. And you're excited enough, and we're just talking about it. There's some new stuff coming down for employers along the way, employees, and so we're going to stay tuned with that. Maybe for people that might have questions about what is the application process look like, right? Mm-hmm. And so if they talk with someone like myself that I'm consulting with people on these matters, there's a list of health questions that we have to go down and we have to answer, right? There's a click an app, and generally it's an e-application. We click the e-application, and then it goes into something called the underwriting process.
Right.
Okay. Now, the underwriting process itself, what does that entail?
Sure. And I will say this before I talk about that. So application process, as you mentioned, is electronic, but we also have PDF fillable apps. Believe it or not,
nice.
We have some clients who are skeptical of the virtual world and won't do anything but a paper.
Okay.
So we have that option. But as far as the underwriting process goes, it's pretty straightforward. Once the application is complete, medical records are ordered from your care providers. We follow up within a couple of days when that application hits our office and follow up with the clients themselves just to verify that we have all their information correct, and then ask a handful of health questions that might be knockouts. And then at that point, it's just waiting for medical records. Once we get the medical records in and evaluate the case, if it's acceptable, great. We can rate it or decline it. We're declining on average probably about maybe 40% of the business right now.
Okay.
And it's all varies based on age.
Yeah. So the sweet time to be looking at this type of coverage with NGL would be in your 40s and your 50s, right?
That's the most affordable, highest likely for approval, all that.
Yeah.
Correct.
And when you're in the 40s and your 50s, how long does it take to get an approval? Generally, it's taking 4 weeks, 5 weeks, 6 weeks. What is it taking?
On average, about 26 days.
26 days. Wow.
It's getting faster. We have a new application process. It's a new electronic app that actually orders the medical records during the underwriting process.
Right.
It's already cutting days off.
Right.
But, AI is going to change a lot of that in the very near future. So.
Talk to people that are in their 40s or 50s again, and the 40s and 50-year-olds wonder what in the world is long-term care. Well, A, they might have seen mom or dad or grandparents go through it. B, maybe they're building up a large 401k on their end, and they're putting this retirement money in there, right?
Right.
The problem is if they do have, and believe me, I have a client who's got a son-in-law that's in his early 50s with advancing Alzheimer's right now. So he's trying to help his daughter. And so if they had large 401ks, they don't, but if they did, they would be going through that, draining that out. And, the missus, the young, wife of early 50s, she's going to not be left with any 401k because he's going to go through it with that care.
Yep.
Right.
So you're bringing up a critical point. For that age group, this is 401k insurance.
Yes. There you
want
go.
to look at it that way. So, because guess what? They're in their peak building years for their retirement, only to have to deconstruct it before they retire. That's a travesty.
That's unbelievable. And then, so then we got people in their mid 60s. They're looking at it too, and we've been talking about this on the recordings. But we're just saying that when people are in their early retirees, 62 to 66, 67, the long-term care planning is going to be different than it is in their 40s and 50s.
Very much so.
Yes. And formally, and also, and this is where even myself having, with what I do with people is if we're in that age range, we're looking at a lot of options, and it may not include what Larry and also NGL offers, because now we're moving into products and solutions that are not health-based long-term care. We're looking at asset-based. So it's important that even if you're in your 70s as well, there are ways to look at long-term care coverage. You have to be very creative, Larry. I can tell you that.
Yeah, it's interesting when you think about this group too. We talk about 401k insurance and all that stuff. One thing that people lose sight of when they think about all the risks they face.
Yeah.
This is the most precarious one because, first of all, you can't predict how the outcome's going to
Nope.
go. You can't predict when it's going to happen. Extraordinarily expensive. And I heard a really wise financial advisor tell me that for his clients, this is the single greatest unfunded liability his clients face.
Unfunded liability. Wow.
He says,
Yeah.
and he said that because it's such an unwieldy risk, I can't look my client straight in the eye
Yeah.
and say, yeah, you'll need this for 3 years or 2 years,
Yeah.
and it's going to cost this much.
Yeah.
You can't do it.
Yeah.
So he said, all you can do is hedge your bet.
Yeah.
And do it in a tax-efficient way.
There you go.
So he also is big on cash flow. This is cash flow,
Yeah.
but tax-free cash flow.
Yes, sir.
So I think there's a financial literacy gap when it comes to this area of planning.
Yeah.
That people don't think about, especially the younger people.
That's right. And and one of the things that recently came up too, Larry, was this, and that is for all the cases that are going to be 24 months long, 36 months long, 4 years long, 5 years long, whatever that is, 100% of them have to go through the first 3 months.
Right. Exactly.
Or the first 6 months.
Yeah.
Or the first 12 months, right? Mm-hmm. And so we've talked this before. If you're in a state that offers short-term care, why there is an opportunity to look at that. It's not available in Washington, not in New York, and not in California, but short-term care is taking care of that first 3 months, 6 months, 9 months, or 12 months. And so there's another solution to look at. And also, I would say, and I think you would agree with this too, is that you've been in the business, Larry, since how long?
Since 1990.
Since 1990. So there are those that may push their elimination periods out, they're getting rate increases going on. They push their elimination periods out. That becomes a danger too, because then they do have a problem.
Right.
And now they're waiting for 180 days. If they pushed out to 180 days, that's a long time to be sucking. So I would encourage people to look at, backfilling, making sure those early days of care are being taken care of.
Well, and I think that's where short-term care plays a unique role because what you can then afford to do is take a less expensive, longer elimination period, like that 180 day.
That's right.
And pair it with one of those short-term care plans to pay the bills. Because guess what? You're going to be benefit eligible at some point.
That's
you're
right.
Going to file a claim.
That's
right.
right.
So as long as you're in that space, then at least you're getting paid along the way.
Absolutely. So, well, good. I want to just chat for just a second or so as we went live on all the platforms. Turning 65 is the channel, and so it's always fun to go live impromptu. I hope to be able to get something going on a regular basis. But Larry was just in the studio here, and we wanted to quickly go live and say hi to everybody, and we'll be posting NGL stuff as we go along as well. I think it's worthy of making sure to educate clients as to the different products and carriers that are there, because let's just say you guys don't have a blimp flying over the Super Bowl, do you?
No, hardly at all.
So just because you fly into the weather under the radar, if you will, doesn't mean that we shouldn't get the good word out, and we can do that on the social media platforms and the talk shows and all that. So, all right, well, thanks for jumping on today, Larry, and we'll hope to have you in again. We'll be excited about the new products coming out this fall. So
exactly. Thanks for having me.
You bet.